I don't know about you, but I personally like to pay attention to the insiders because they know the company much more than we could ever know it. I pay attention to see if they're buying stock or if they're actually selling. If they're selling, they may think the stock is expensive. If they're buying, they may think the stock is cheap. And I've been getting a lot of notifications around Crocs because the insiders have been buying a lot lately, since pretty much February. February to May 17 has been buy. Every time, they buy, the director, the CFO has been buying, the vice president. Everyone is pretty much buying the stock in the company. And nobody has sold the stock since pretty much November 5 was the last sale. Now, they did not buy a lot of shares values. They bought, 200,000 here, 400,000 there. So it's not a lot of shares. But they actually bought, which is a good sign. But that doesn't mean we should go run and go buy the stock just because the insider bought in. Because as we saw with a company like DocuSign, the CEO was buying and many people bought because the CEO is buying. And after he bought, the stock went down 50%. So the CEO and the company executive are not always right. It doesn't mean the stock is cheap. They could even be making a mistake. I mean, it just happens. So this is the reason why we're gonna do a fundamental analysis on Crocs. This is my second video on it to determine if it's a buying opportunity or not, especially at this price of $48 a share. The company got bid up over $182 per share and now is sitting back at $48. So it could be something interesting to look at. Now, the big concern with those companies like Crocs and those retail kind of companies is because of the inflation type of stuff. Many people are not buying a lot of shoes like they used to. They're not buying expensive stuff. Now, so let's look at their quarterly results to see what really happened. Now, their first quarter growth was 47%. Is a testament to the underlying strength of the Crocs and Hey Dude brand. Consumer demand remains strong, giving us the confidence to raise our full year outlook to approximately $3.5 billion. So while everybody is missing on earnings, Crocs is beating earnings and is actually raising their guidance. Now, that doesn't mean that, the consumer demand is going to remain strong for the end of the year. It could get a little bit weaker, but they're pretty confident about it, and they raised their EPS to $10.05 to $10.65. Now, the stock itself is $48, so this is around a 4.5 to 5 PE if they were actually able to hit those targets now in 2022. Now, the stock is very cheap at 4.5 PE. So let's take a look a little bit deeper and kind of compare it to other peers in the industry like Skechers, like Nike, like Adidas. And on a PE basis, we could see that Crocs is around 5, Skechers 12, Nike 29, and Adidas around 12. So Crocs is the cheapest of the bunch. Now let's look at their margins. Maybe their margins are kind of lower, and this is why the stock is cheap. But looking at the gross profit margins, Crocs is by far highest than all of them, even higher than Nike's and Adidas. And even looking at the free cash flow margin, it's not the highest, but it's pretty much in line with Nike. And Adidas here takes the space. Return on asset is pretty much the highest between all of them. So you could see they don't have very kind of low margins to justify this 5 to 4.5 PE. So why is the stock beaten down so much? Why is it trading so low? Well, there's one main reason for that. If you remember, I told you about Crocs and Hey Dude. Hey Dude is an acquisition they made, and I covered it in my previous video more in depth. But it's essentially a pretty popular shoe company. Many people know it. Many of you have even bought that kind of stuff. It has a lot of reviews on Amazon, bestsellers, around 27,000 reviews, 58,000 reviews, 20,000 reviews, a lot of reviews, and people actually really like the products. I have many friends that bought those shoes, and they actually really like them. And Crocs actually acquired the brand. But there's a fear that Crocs may be overpaid for the brand, and they actually did it at the wrong time. Like if Crocs just waited 2 or 3 months, they could have got it for 20-30% cheaper. But again, they didn't really do that. They just, I believe they did it at the wrong time, and they a little bit overpaid for it. And this is kind of allowed them to have a messed up balance sheet, and they racked up a lot of debt. And that is always an uncertainty in the stock market. But this is what I like. Everybody wants a company with high cash and low debt. But because everybody wants it, it trades at a premium. Okay. But if we can actually dig in where some things that nobody wants, maybe some things that has a lot of debt, maybe we can find some value because many people skipped it just because they got scared from the debt. Okay, so let's take a look a little bit deeper. They have around $171 million of cash. That's really not bad at all. But looking at the long-term borrowings, $2.8 billion of debt. So their total liabilities is $4.1 billion, and the company in all is like $3.5 billion. So that's a lot of debt for this type of company size. Now, whenever I look at that $2.85 billion of debt, that's a lot of debt. I want to make sure that this debt is not going to expire next year or in 2 years. When is the maturity of the debt? And is the interest very high that the company cannot pay it? Well, looking a little bit deeper, here on the 10Q, I actually found this information. Most of this debt is maturing between 2029 to 2031. This is when most of the debt is maturing, so, pretty much in the future. And from me knowing Crocs' free cash flow, knowing how high their net income is, which I'm gonna show you, I believe they can easily pay this off. They had a share buyback program, they were doing many things, they stopped it all, and they're really focused on reducing the debt, and I personally think they can easily do it. Now, the interest rate is a little bit high, around 4.5%, considering that we had pretty much 0% rate. Many companies were getting 1 to 2%. So 4% was a little bit high. But again, I don't really think it's too high, as Crocs is a free cash flow machine. It's making a lot of net income. I personally think they can afford it. And it's high in the future, 2029 and 2031. So I don't think that that is a big issue as long as Crocs can actually pay for it. And I'm going to show you the net income potential with the company going into 2026. Now, I'm going to kind of show you something which many people are not paying attention to. Now, looking at Crocs, it's not dead at all. Many people say that, nobody wants to buy Crocs or whatever. This is not the truth. The company has been growing revenues, as I showed in my previous video, and it continues to grow revenues. Looking at their digital penetration is around 32%, 35% direct-to-consumer from their own website. And they are international, North America, emerging market, in Asia. But here's the trick. Hey Dude is a very popular brand. It's a best-selling brand on Amazon. But Hey Dude, with all those reviews and everything, it's still only in the United States. Now, Crocs itself is integrated around the world, in Asia, especially in China. Many people kind of like Crocs and stuff, in emerging markets, in Europe, in USA. Hey Dude is only in USA. So Crocs can easily expand Hey Dude internationally and kind of build out the brand. So that's pretty amazing, and this is something kind of a lot of people were not really thinking about. Okay, now looking a little bit more, as I said, they were actually had a pretty amazing share buyback program. Their shares were 71 million in 2019, now it's 63 million. So they reduced a lot of shares, but again, they stopped this program in order to pay the debt. And paying the debt is a priority, much better shareholder value than actually buying back shares for now. Okay, now their guidance for 2026 is around $6 billion in revenues and 26% operating margins. Now, my numbers were more conservative. Again, this is their long-term guidance, and they defined long-term guidance as 2026. So 2026, they expect $6 billion. Now, my valuation model is much more conservative, and even if we get more conservative with my own conservative valuation model, we could see that Crocs is pretty much still cheap, no matter how we put it. Okay, so let's look a little bit deeper. This is my valuation on Crocs, 2.3 billion here in revenues. They're gonna grow 53%. This is their guidance because they acquired Hey Dude. So this is an entire new revenue source that's gonna come to Crocs. With Hey Dude 53% growth, this is 3.5 billion. This is their recently updated guidance. And then I put them at 10% for 2026. Now the total revenue will be 5.1 billion. Their guidance is 6 billion. So even if they missed by $1 billion, we're still on the safe side with 5.1 billion. And as you could see, we're gonna get even more conservative in terms of Crocs. Okay. Using their net income margins which they have right now, it would be around 927 million. Now I personally think they could even have higher net income margins because Hey Dude shoes, they sell for much more and they are less capital incentives than actually many of the Crocs products. But we're gonna see how it's gonna look like in the future. So I kept it the same around 18%. For a PE ratio, now it's trading at a 5 PE. Nike is trading at 27 PE. Many regular shoe companies and historically Crocs traded between 10 to 15 PE. So I don't see if Crocs pays a lot of debt by 2026, why it can't at least trade at a 10 PE with such high margins if they have lower debt, So I don't think 10 PE is too much for the company. So using the 10 PE, we get a $9.2 billion market cap. The current market cap is 3.3 billion. This is 181% on the upside over the next 5 years. Using on compounded annual growth rate, you get 23% every single year for the next 5 years. Now let's assume with those conservative numbers, if we want to get even more conservative and get a 20% margin of safety, this is still 124%. So you're pretty much gonna double your money over the next 5 years if you buy Crocs right now. And forget even if they can even get to their 6 billion of actually revenues by 2026, the upside is going to be much higher, not even including their share buyback program and a potential dividends that they can introduce in the future. So for me, Crocs, yes, is a buy, but I'm not saying the stock can't go down more. Many of you see my videos and say, hey, you talked about Google and Google went down. Well, I don't really control the market. In this market, the cheap gets cheaper. Here, my job on YouTube is to tell you if a stock is cheap or expensive. It doesn't mean it can't get cheaper, and it doesn't mean it can't get more expensive. So you could watch my video and do your own research and determine what is your buy point for Crocs, so you could do your own strategy and what's best for you. Of course, none of this is financial advice, so thank you so much for watching, and I hope you enjoyed it. If you liked it, please press the like button and maybe consider subscribing. So I hope to see you in another video.